Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 10th of January. I'm Daniel Lam, your host for the podcast. When I first started in the wealth management industry 8 years ago, investors were getting headaches in trying to obtain a reasonable level of income because interest rates were so low in those QE era. They were trying methods such as taking leverage on fixed income in order to boost the yields. And naturally, they were also looking at high dividend yielding stocks as well. Fast forward to 2024, the question from media interviews is how US companies should be redistributing their cash. Now, they were asking me if US companies would be boosting their share buyback in the upcoming Q4 earnings season. Well, my view is that share buyback is sensible in the current environment because it would reflect the management's confidence in the companies, and also companies will probably get the bigger bang for the buck for buying back the shares rather than paying them out as dividend, because high dividend yielding stocks would have a harder time competing on yields versus bank deposits as opposed to 8 years ago. So overall, we're expecting a healthy fourth quarter earnings season in the US. Now take note that there has been some scaling back in the expectations for this earnings season because some of these earnings have been pulled forward into the third quarter. For example, according to IBES, consensus expectations are for the fourth quarter earnings to grow by 5.2% year-on-year, which was a slowdown from 7.5% in Q3. Now, back in October 2023, consensus were expecting growth to be at 11% for Q4 and 1.6% for Q3. Now, for the full year earnings, consensus is currently expecting 2024 earnings to grow by 11.1% and 2023 earnings to grow by 3.1%. So we're still expecting strong earnings rebound this year versus the slower growth in 2023. We expect to see positive earnings growth across all the 11 sectors in the S&P 500 index, led by healthcare, 17.5%, technology, 16%, and communication services at 16% also. Healthcare is rebounding after weakness in 2023, while technology is supported by continued strength in software companies and an expected turnaround in the semiconductor cycle, as we discussed in details yesterday. These three are our preferred sectors in the US, and we're expecting that broad earnings strength will be supporting US equities over a 6 to 12-month horizon. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.